Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Welcome back. Today's video is about part 2 of technical analysis, so hopefully you've looked at part 1. If you haven't, please go watch part 1 because it gives you the basics to what we're talking today. We're getting a little bit more complicated and throwing some chart patterns at you. So today's topics include chart patterns such as resistance and support levels, tops and bottoms, and chart gaps. And then there's also part 3 which will introduce some more chart patterns. Our first topic today is about technical resistance and support chart levels. So you can see from the chart that we're providing you, what the market is doing is rising, and all of a sudden it gets to some resistance or high. Resistance is the expectation that a price will not exceed its existing high. Resistance plane is drawn across those past highs, so you can just, basically you draw a line and you connect the points. An increase in demand or a reduction in supply can penetrate that resistance. So here's an example of resistance with the 2011 soybean November daily futures chart, and you can see I drew a line, a red line at the very top there where I'm connecting all the points, and that's your resistance plane. Of course, sometimes the market can break through that, but in this case it never did. So how do you manage this? Well, if you're using futures, you can place a short hedge along that plane, particularly at market highs or at record highs. Here's another example, resistance plane with the 2011 December corn daily futures chart, and again the market is rising and rising and rising, and finally for some reason it's starting to trade sideways, and you get this resistance plane where you draw that red line and you connect the dots. And again, perhaps that's where you put your short hedge in, or that's where you call your local elevator and decide, hey, I'm going to sell some bushels at this level plus or minus your local basis. So what's a support line or a support plane? Support is the expectation that a price will not fall lower than its existing low. Support plane is drawn across past lows. So you can see in our example here, the market is falling, and then finally it seems to hit a low. You draw a line there and you try to connect the dots to create that support line or support plane. With a decline in demand or an increase in supply, price can dip below that support plane. Here's an example with the 2011 canola November daily futures chart, and you see the market had rallied, hit a resistance. So in this case we can draw both a resistance plane and a support plane. The resistance plane would be where the market peaks, and then the support plane is when the market starts to come down, and you connect the points. So what's your best fit, and you start to get into this trading range. You're drawing your trend lines and you get this trading range. Now, it could eventually break that support line over time. In this case, it continued to go sideways. So how do you manage this? Lift your short position on a dip towards that support plane. So you've maybe put a short in, and the market's been falling. All of a sudden, it's hitting a low. It's bouncing off of that support plane, and maybe you put an order in with your broker to lift that short hedge towards that support plane. Particularly at market lows or record lows, or when you have physically sold grain to an end user. So in other words, you've harvested, you physically delivered it, you still have a short hedge on, you no longer need that short hedge, you need to lift it because otherwise you become a speculator. And what are we supposed to do? We're only supposed to be hedgers. Here's an example with the 2011 December corn weekly futures chart, and again you can see where the market bottomed a couple times. Sometimes markets will retest that bottom more than once. It doesn't have to do it once, it can do it twice. In this case, you can see that it touched the bottom twice. You can draw that support line, bounces off of that, and perhaps that's where you lift that short position. If you bought enough time, eventually the market rallied and went back to the highs, and again you can connect the dots and draw a resistance plane, and that's maybe when you sell some more bushels forward. Our second topic today is about technical top-bottom chart formations, and you can see from our example, think of them as two large hills or mountains, and you connect the two dots at the very top, the double top along the major resistance plane, more significant than a single one. So if you get a double, it's more significant than the single. You got to pay close attention to that. This usually singles the top. So in our example here with the 2011 Kansas City wheat December daily futures chart, you can see there's a couple double tops there. Did it eventually peak? Yes, it didn't quite peak then because you draw that support plane, but eventually it did and it broke lower, and that would have saved you some money. Triple tops. Note the triple top along the major resistance plane, more significant than singles and doubles. Triple tops are rare. So if you do get a triple top, pay attention. Usually a triple top means the price has peaked and prices can go considerably lower. So here's an example with the 2011 September natural gas daily futures chart, and this one clearly you can see the triple top. It doesn't necessarily show you that this thing is breaking below that support plane, more or less going sideways as the moving averages start to flatten out, but that's a classic triple top there. There's also double bottoms. Note the double bottom along the major support plane, more significant than the single. It's basically an upside down top. Here's an example with the 2011 July CME Lean Hog Daily Futures chart. There's a classic example of a double bottom. Again, you draw the resistance plane, it breaks above that resistance plane and the market goes considerably higher. Triple bottoms, note the triple bottom along the major support plane, more significant than the single or double. Again, triple bottoms are rare. Here's an example with the 2011 July Copper Daily Futures chart. And sometimes they're not clearly spelled out like in my diagrams that I provide, but yeah, there's some subjective viewing. So there is a triple bottom there, but it's not clearly depicted, but you can see that. Now, again, in this case, wasn't a true signal. Market, after that triple bottom was created, went lower, but eventually went back up. So sometimes you do get some false signals. So resistance at contract highs is significant. Resistance at recent highs, which were also highs in the past on a continuation chart, are quite significant. Resistance at double, triple tops is very significant. The same can be said for singles, doubles, and triple bottoms. Our third topic today is our technical chart gaps, and these are important because they're not common, but when you get them, you got to pay attention. So chart gaps occur in fast-moving markets. The market tries to fill chart gaps. If the gap is not filled, it can take on a special significance over a longer period of time. So you can see in our diagram here, the gap occurs because the next day the market opens higher than the previous day's closing or high for that day. So here's an example with the 2011 December corn daily futures chart, and you can see clearly there's a gap there at the end of the chart where it moves lower, and then all of a sudden the market moves higher from there. There's different stages of chart gaps. There's a breakaway gap. So the first one, as in our diagram, the first circle is known as a breakaway gap. Occurs when the market starts a major move up or down. A measure gap occurs when several days after the move starts. So it follows the breakaway gap. And then the final one is the exhaustion gap. Occurs when the market move is approaching close to an end. That if you get that third gap, that exhaustion gap, it signals that the top is near, and you need to pay attention. So here's an example with the 2011 August feeder cattle daily futures chart. There's your triple top. Market continues to move higher, draw a resistance plane, and eventually the market peaks and we move lower. So in summary, understanding chart patterns such as resistance, support, tops, bottoms, and chart gaps can help producers when to hold and when to fold. It's like poker, right? Or when to pull the trigger. Technical analysis should be used in combination with fundamental analysis, because if you use technical analysis alone, it's not 100% accurate. Think of technical analysis as a form of trying to predict the market or when a trend is going to change.